Islamic banking exposed: the truth behind interest-free finance. In a global financial system plagued by predatory interest rates, debt traps, and unchecked corporate greed, Islamic banking markets itself as a moral and spiritual alternative. Framed as interest-free and Sharia-compliant, it claims to offer an ethical pathway to wealth building, rooted in justice, fairness, and divine law. But behind the glossy branding and theological justifications lies a troubling reality. Islamic banking, in its current form, functions almost identically to conventional finance. The terms may change: profit instead of interest, Ijara instead of lease, but the outcomes remain eerily the same. This exposé pulls back the curtain on the so-called revolution of Islamic finance. It traces its modern rise, dissects its most common products, unpacks its hidden costs, and explores whether the entire industry is a sincere attempt at religious finance or a rebranded illusion designed to profit from belief. A brief history, from sacred prohibition to global industry. The foundation of Islamic banking lies in the Quranic prohibition of riba, commonly translated as interest or usury. Islam's classical jurists, drawing from both scripture and pre-Islamic economic practices, viewed riba as unjust enrichment that exploited the vulnerable. For centuries, this principle shaped economic life across the Muslim world, fostering trade, partnerships, and charitable endowments, waqf, instead of debt-based accumulation. But the Islamic banking system we see today did not emerge organically from the Prophet's era or classical fiqh. It began in the mid-20th century with a convergence of post-colonial identity politics, Gulf oil wealth, and global capital markets. Egypt's Meet-Gamer Bank, 1963, is often credited as the first modern Islamic bank. By the 1970s, petrodollar-rich countries like Saudi Arabia began funding large-scale Islamic financial institutions, partly in response to the growing influence of secular Western banking in the Muslim world. The movement gained momentum after the 1979 Iranian Revolution and the Islamization policies of Pakistan and Sudan. Soon, major multinational banks saw an opportunity. HSBC, Citibank, Standard Chartered, and Barclays launched Islamic divisions, eager to tap into a rapidly expanding market of faith-conscious consumers. Today, the Islamic finance industry is worth over $3 trillion globally. It is present in more than 80 countries. But its success has invited a difficult question. Is it truly Islamic in substance, or merely Islamic in branding? Murabaha, interest rebranded as profit. At the heart of Islamic finance is a structure known as Murabaha. It is touted as a halal alternative to a loan. But when you examine it closely, it begins to look like interest in disguise. Here's how Murabaha works. The bank buys an item, house, car, etc., on your behalf. It resells that item to you at a higher, pre-agreed price. You pay back this price in installments. Technically, there is no interest charged, but the markup functions exactly like a conventional interest rate. The bank's profit is calculated based on prevailing interest rates in the market. In fact, many Islamic banks tie their Murabaha markup to the London Interbank Offered Rate, LIBOR, the same benchmark used by conventional banks. In practice, Murabaha has become the dominant product in Islamic finance, representing over 70% of transactions. Critics argue that it's nothing more than semantic gymnastics, calling interest, profit, and debt trade without altering the underlying mechanics of debt accumulation. Ijara, the lease that walks like a loan. Another popular structure is Ijara, or Islamic leasing. Here's the basic setup. The bank buys an asset and leases it to the customer. The customer makes regular rental payments. Ownership is transferred at the end of the lease. Again, this avoids the term interest, but in reality, the payments mimic an amortized loan. The rental amount includes a built-in profit margin, often benchmarked to conventional interest rates. This structure is commonly used in real estate and auto financing, and like Murabaha, it produces the same financial outcome as a traditional interest-based lease, only repackaged with Islamic terminology. Tawaruk, the artificial trade loop. Perhaps the most controversial Islamic finance structure is tawaruk, also known as commodity murabaha. It's used to provide cash to clients in a Sharia-compliant way. Here's how it works. The bank buys a commodity, like aluminum or oil, on behalf of the client. It sells the commodity to the client at a markup. The client immediately sells it to a third party to receive cash. This practice creates a legal fiction of trade that serves no purpose other than to replicate a cash loan. Many Islamic scholars have criticized tawarruk as a form of legal trickery, hayal, where the prohibition of riba is sidestepped through procedural sleight of hand. Hidden costs, higher fees, and dubious ethics. Beyond semantics, Islamic banking often comes with higher financial burdens for consumers. Fixed rate structures. Because variable interest is impermissible, Islamic banks offer fixed rate Murabaha contracts. To hedge against market fluctuations, they often charge higher upfront prices. Increased legal and admin costs. Sharia compliance requires legal vetting, multiple contracts, and third party documentation, costs which are passed on to the customer. Late payment penalties. While Islamic banks claim not to profit from late fees, instead donating them to charity, the penalties still exist. Customers still suffer the consequences despite the ethical rebranding. Opaque risk sharing. Islamic finance claims to promote risk-sharing models like Mudaraba and Musharaka. In practice, these are rarely used due to their complexity and legal exposure. Banks prefer Murabaha and Ijara, which transfer all risk to the consumer, just like conventional lending. Case Study 1. HSBC Amanah. A facade unraveled? HSBC launched HSBC Amanah in the early 2000s, presenting it as a global leader in Islamic finance. It offered Murabaha home financing and ethical investments. But in 2012, a series of internal reviews and regulatory concerns revealed that many of its Murabaha deals were essentially interest-based loans with rebranded paperwork. Facing increased compliance scrutiny and profitability issues, HSBC shut down its Islamic banking operations in several countries. The incident was a stark reminder that even the biggest Islamic finance players often struggle to meet both Sharia requirements and modern banking standards. Case Study 2. Dubai Islamic Bank's $500 million scandal. In 2018, Dubai Islamic Bank, DIB, the largest Islamic bank in the UAE, was implicated in a $500 million money laundering scheme. Investigations revealed that funds labeled as Islamic finance were routed through shell companies and fake trade documents. The scandal showed that Sharia compliance does not guarantee ethical behavior. In fact, the religious branding of these institutions may allow them to avoid deeper scrutiny from regulators and the public, the scholars, the boards, and the conflict of interest. Every Islamic bank employs a Sharia Supervisory Board, SSB, a group of Islamic scholars tasked with reviewing and approving products. These boards are central to the industry's credibility. But here's the catch: these scholars are paid by the banks themselves. This creates a conflict of interest where scholars may be incentivized to approve questionable products to maintain relationships with banks. A 2017 study found that a small group of elite scholars sit on dozens of SSBs worldwide, raising concerns about monopoly, rubber stamping, and a lack of critical theological debate. Some scholars have openly criticized this system as tokenistic, where religious approval is commodified to serve capitalist ends. The regulatory admissions, It's just branding. Even financial regulators admit the structural similarities between Islamic and conventional finance. In 2020, the UK's Financial Conduct Authority, FCA, published a report stating that Islamic financial products were structurally indistinguishable from conventional ones. The main differences were in terminology, branding, and marketing. The International Monetary Fund, IMF, reached a similar conclusion in a 2019 report that Islamic finance offers no statistically significant advantage in financial inclusion, efficiency, or ethical impact. Additional insight when the industry quietly admits the truth. The criticism of Islamic banking structure isn't just coming from outside observers or academic critics. It's acknowledged quietly by professionals who've worked within or alongside the system. One insider summary explains it this way: Islamic banks don't charge interest, they use the word profit instead. Murabaha is structured so the bank buys an asset and resells it to the client at a markup. In any other context, this is a loan, and the markup is equivalent to interest. Profit rates are calculated using the same formulas used by conventional banks and benchmarked against standard interest rates. Ijara leasing does the same. Even though interest is never mentioned, the monthly payments are structured and calculated using the same models. Islamic loans also can't include variable interest, so banks issue short-term contracts and roll them over every year to adjust for rate changes. Late fees go to charity, but customers still pay penalties. In the end, Islamic banking offers the facade of Sharia compliance, but its internal operations are the same. It's not that the numbers are different, only the names are. This honest breakdown confirms what critics and economists have been arguing for years. Islamic banking is not a fundamentally different system, it's the same engine with different labels. So, who benefits? If Islamic banking replicates the outcomes of conventional banking, charges higher fees, and is riddled with semantic loopholes, who is it really serving? Financial institutions profit from consumer trust without changing their practices. Sharia boards receive lucrative positions and global recognition. Consumers, however, often end up paying more for products that offer no real ethical or structural difference. What began as a spiritual response to economic injustice has morphed into a multi-trillion-dollar industry that commodifies belief. It sells the comfort of piety in a package indistinguishable from the system it was meant to resist. Conclusion: time to question the illusion. Islamic banking was born from a noble aspiration to create a financial system rooted in justice, compassion, and faith. But in its current state, it risks becoming the very thing it once sought to escape: a profit-driven engine cloaked in morality. The illusion of interest-free banking persists because it offers religious consumers peace of mind, but peace of mind should not come at the cost of truth. If the numbers are the same, the debt structures identical, and the profit motives unchanged, does the terminology really matter? It is time to demand transparency, reform, and accountability. Because when faith is used to sell finance, the cost isn't just monetary, it's spiritual.